Welcome to a deep dive. Today, we're getting to something huge, really shaping the global economy, America's whole approach to tariffs and trade.
And we're really going to lean into the thinking from Stephen Miran's user's guide, which seems to be, a big influence behind the scenes.
Yeah, and you've given us a great pile of stuff for this. Articles, research, notes, really digging into the history, the current mess, and, well, where things might go.
Our mission today, really, is to pull out the key takeaways from all this material.
Right, help you get a handle on what's actually driving these policies, why they're so controversial, and what it could mean for, your business, your investments, or just understanding the world economy better.
Because often what looks like maybe chaos or just random economic moves, it might actually be part of a bigger, deliberate, long-term strategy. So let's try and unpack that strategy and see what the sources say about its chances, really.
Okay, let's kick things off with the basics. Tariffs. What exactly are they? The sources say they're pretty straightforward, taxes on imported goods.
Yeah, and the classic reasons are, one, raising money for the government.
Okay.
But maybe more importantly, especially now, it's about protecting domestic industries. You make foreign stuff pricier.
Right.
So local alternatives can compete better. And maybe, just maybe, foreign companies might build factories here to avoid the tax.
And the U.S. has used tariffs for a long, long time. Your sources have some really interesting examples, like the chicken wars back in the 60s.
Yeah, a classic case study. The EEC, the European Economic Community back then, they put duties on U.S. chicken imports, about 13 cents a pound, I think.
Doesn't sound like much now, but it clearly stung.
It did. They wanted to protect their own growing chicken industry.
So how did the U.S. respond?
Well, the sources show President Johnson didn't wait long. He retaliated, put tariffs on a bunch of European goods. Light trucks were famously included.
Right, the chicken tax on trucks, people still talk about that.
Exactly. It shows how fast these things escalate, Protectionism breeds more protectionism.
You hit my chicken, I hit your trucks. Simple, almost. And then there's this legal tool the sources focus on. Section 232 of the Trade Expansion Act of 1962.
Yeah, that's a big one. It gives the president a lot of power to restrict imports if they're seen as a threat to U.S. national security.
And the key thing the sources stress is how national security has been stretched over time, right? It now covers economic security, too.
Precisely. That expansion is crucial because it gives a legal justification, or at least a hook, for a lot of recent tariffs, steel, aluminum, cars. The argument is they protect industries vital for defense or just the economy's health, even if it's not a direct military threat.
Definitely broadens the playing field. Now, when we look back, details can get fuzzy. Your sources also clear up a couple of things people sometimes get wrong, like President Reagan slapping big oil tariffs on in '82.
Yeah, the sources say that's not quite right. Actually, Reagan lifted the last remaining price controls on domestic oil early on, 81, I think. Well, his whole thing, Reaganomics, was generally about deregulation, less government interference, freer trade. So imposing new protective oil tariffs wouldn't really fit.
Makes sense. Okay, good correction. What about President George W. Bush? Uranium tariffs in 2001. Was that a thing?
The sources don't mention Bush imposing tariffs on uranium imports then.
Yeah.
They talk about the whole Iraq yellow cake controversy, based on forged documents.
Right, I remember that.
And the deal with Russia to buy up weapons-grade uranium. But nothing in this material about specific tariffs in 2001 to protect the U.S. uranium industry.
Interesting. Shows how easily history can get twisted. Really highlights why we need to dig into the sources like this.
Absolutely. You need that detailed analysis to separate fact from, well, myth sometimes.
Okay, let's shift gears. Moving from history to a more recent, really big problem. How U.S. manufacturing kind of lost its top spot. After World War II, the U.S. was just dominant, making like half the world's stuff.
Yeah, incredible position. And the U.S. used that power, in part, to help rebuild Europe and Japan, opening its own huge market, setting up systems like Bretton Woods, trying to get trade going again.
And that eventually led to this era people called Chimerica, this really intense economic link between China and the U.S., especially from the 90s onward.
Right. China became the factory, making everything cheap, and the U.S. became the consumer, buying it all, often on credit.
And a key part of that was China keeping its currency, the renminbi, cheap compared to the dollar, wasn't it?
Absolutely. Deliberately undervalued, made their exports incredibly cheap. And China built up these massive dollar reserves, which they then plowed back into buying U.S. debt, like Treasury bonds. That helped keep U.S. interest rates low. For a while, it seemed like everyone was winning.
But your sources argue this created huge structural issues for the U.S. economy. That strong dollar, partly because it's the reserve currency everyone
Yeah.
needs, made U.S. exports expensive while imports were dirt cheap.
Which just crushed domestic manufacturing. Factories shut down, millions lost jobs. The U.S. started running these enormous trade deficits year after year.
And then COVID? The sources really point to the pandemic as a massive wake-up call.
Oh, definitely. It just brutally exposed how fragile those global supply chains were.
Uh,
Suddenly, the U.S. couldn't get basic things like masks or medical gear because production was overseas.
and there was that audit in 2023 showing China dominating in, 37 out of 44 key technologies?
Stark figures, a real shock, especially for the defense sector. Realizing how dependent the U.S. military-industrial complex was on China for vital components, rare earths, it forced a total rethink.
So the argument is the economic efficiency we got from globalization under Chimerica, it came with a massive geopolitical price tag, a dependency that now looks like a serious national security risk.
Exactly. And the sources suggest current policies, especially the ones associated with Trump and maybe continuing, are driven by this need to de-risk, to bring critical industries home, reshore them, even if it costs more in the short run. Security and autonomy are the top priorities now.
And there's this underlying economic theory the sources mention, central to Miran's argument, the Tariff dilemma.
Yes, driven. Sounds technical, but the idea is pretty fundamental.
Lay it on us.
Okay, so if your currency is the world's main reserve currency, like the US dollar,
Yeah.
you have to supply enough of it for global trade and finance. The easiest way to do that is to run trade deficits, buy more from the world than you sell, sending dollars out.
Okay, got to get the dollars out there.
But this constant global demand for dollars keeps the dollar's value high, often artificially high or overvalued.
And that hurts U.S. companies trying to sell abroad.
Exactly. Makes exports expensive, makes imports cheap. It directly undermines your own manufacturing base. Miran sees this as a basic flaw in the system the U.S. needs to fix.
So it gives a kind of systemic reason for policies like tariffs, doesn't it? It's not just random protectionism, maybe, but trying to correct this deep imbalance caused by being the reserve currency issuer.
Precisely. It frames it not just as America First protectionism, but as a necessary adjustment, because the U.S. is carrying this burden imposed by the global financial system itself, a system it helped create, ironically.
Okay, so the U.S. sees these big structural problems, Chimerica's legacy, the Tariff dilemma. What about the body meant to manage all this? The World Trade Organization, the WTO. Its goal was smooth, rules-based free trade, right? A place to talk, resolve disputes fairly.
That was the idea, yeah. A multilateral system with clear rules to stop countries just doing whatever they wanted, prevent protectionism, ensure fair play, keep things stable.
But your sources highlight some major doubts about how well the WTO is actually working now, especially how slow it is at resolving disputes and its struggles dealing with, let's say, unfair tactics by state-backed companies.
Look at solar panels. The U.S. basically invented the core tech. But China poured subsidies into its industry, allegedly dumped panels below cost, and just grabbed huge market share. The U.S. complained to the WTO.
And that complaint dragged on for how long?
A decade, according to the sources.
Yeah.
10 years.
Unbelievable.
And yeah, eventually a WTO panel did rule partly in the U.S.'s favor on some safeguard tariffs in 2021. But by then, China already had near total control of the global solar market.
So the ruling was basically pointless by the time it arrived. Too little, too late.
Pretty much. And you see similar frustrations with things like nuclear technology and Westinghouse. Story goes, building reactors in China meant handing over sensitive IP. Then there was cyber theft, hundreds of thousands of pages of trade secrets stolen around 2011.
And suddenly China has its own competing nuclear company.
Right. Now, Westinghouse did settle an IP dispute with some South Korean firms more recently, but the bigger issue of state-sponsored IP theft, particularly involving China, seems really hard for the WTO to tackle effectively or quickly.
Even the old banana wars, U.S. versus EU, back in the 90s. The EU favored imports from former colonies, hurting U.S. companies like Chiquita. The U.S. complained.
And JTT, the WTO's predecessor, actually sided with the U.S. But that fight also lasted, 2 decades?
20 years, over bananas. By the time they settled, Chiquita's European market share was hammered.
These aren't just slow bureaucracy stories. They show how countries, especially those with strong state direction, can sort of play the system, drag out the WTO process for years, while continuing the subsidies or the IP acquisition or whatever. By the time a ruling comes, they've already achieved their industrial goals. The WTO, as it stands, seems kind of unprepared for that kind of state capitalism or strategic gaming of the rules.
Which gives countries like the U.S. a rationale or at least an excuse to say, okay, if the system doesn't work, we have to act alone.
And on top of that, there's a huge structural problem right now. The WTO is a appellate body, the sort of Supreme Court for trade disputes. It hasn't had enough judges to even hear cases since 2019.
So the enforcement mechanism is basically broken.
Effectively paralyzed, yeah.
So you put all that together. If the global referee can't make calls or enforce the rules in a timely way, you can see why a big player like the U.S. might feel it needs to take matters into its own hands.
It really provides the context for the Trump administration's tariff strategy, and potentially beyond. It wasn't just about rejecting multilateralism, maybe, but a reaction to feeling the system itself had failed to protect U.S. interests against new kinds of competition. And that points towards a potentially messier, more fragmented global trade picture.
Which brings us right back to Stephen Miran. The sources frame his user's guide as the intellectual foundation, the coherent vision, controversial, yes, but the blueprint for shaking up the global economic order.
And his main point, tying back to Tariff, is that the overvalued U.S. dollar is the root problem. It's what's killing U.S. manufacturing and driving trade deficits.
And crucially, he doesn't see tariffs as just simple protection. He calls them negotiating leverage, a tool to force a rebalancing of global burdens.
Yeah, he pitches this idea of a rules-based tariff system, where the tariff rate you face isn't random, but linked to things like your trade balance with the U.S., your currency policies, maybe even how much you cooperate on security issues.
So it's about using tariffs to push other countries to change their behavior.
Exactly. To incentivize them to help rebuild U.S. manufacturing, either by investing here or by letting their own currencies rise against the dollar.
And a huge, really ambitious goal is to actively weaken the U.S. dollar.
Yes, that's core. The sources mention this idea of a new global currency agreement, maybe modeled on the 1985 Plaza Accord, which devalued the dollar back then. He's even floated the name Mar-a-Lago Accord.
Kind of provocative naming there. And he's suggested some really out there ways to achieve it, right? Like getting foreign central banks to sell dollars or converting U.S. debt into 100-year bonds.
Yeah, those are the more radical ideas. The 100-year bond concept is about pushing repayment way off into the future, maybe dodging interest rate hikes. But the overall goal of weakening the dollar is clear. Make U.S. exports cheaper, make imports more expensive, and give domestic manufacturing a fighting chance through better competitiveness.
And one really unique twist in his thinking, according to the sources, is tying U.S. defense commitments and market access directly to this currency issue.
Right. He sees things like the U.S. security umbrella and access to our huge consumer market as benefits the U.S. provides. So his framework says if allies want those things to continue, they should chip in by supporting U.S. manufacturing and helping revalue currencies.
It makes economic cooperation almost a requirement for security partnership.
Yeah, it creates economic stakes for security guarantees, which Miran argues might make those guarantees seem more credible because allies have skin in the game economically.
Okay, these are definitely bold ideas. And unsurprisingly, the sources show they've gotten a lot of pushback from mainstream economists and finance folks.
Oh, absolutely. Significant criticism. Some dismiss the more radical ideas, like the 100-year bonds, as just unworkable or even fraught with contradictions. That bond idea has been called a de facto default on U.S. debt.
And hitting foreign central banks holding U.S. debt with a user fee.
That's seen as a potential breach of contract, something that could seriously spook investors worldwide and damage trust in U.S. treasuries as the ultimate safe asset.
Yeah, that sounds risky. What about the tariffs themselves? Miran talks about optimal tariffs, but critics aren't buying it.
Well, he cites some economic models suggesting maybe a 20% tariff could be optimal, in theory, but critics say those are super simplified models. The real global economy is way too complex, supply chains are intricate, predicting the actual effects is incredibly hard. That 20% number isn't seen as very practical.
And then there's the most common criticism, which the sources echo. Tariffs are basically paid by your own consumers through higher prices.
Right. Miran argues currency changes could offset that. But critics say, even if that happens, consumers still lose the purchasing power they would have had with a stronger dollar. It's still a direct hit to American wallets. That's a huge concern.
And deep skepticism remains about whether tariffs, even as part of this grand plan, can actually bring back millions of manufacturing jobs.
The argument against it is that manufacturing today just isn't like it was. It's heavily automated now. It relies on these incredibly complex global value chains. Trying to replicate all that domestically, reshore entire chains, it's seen as potentially incredibly expensive. That could make U.S. goods uncompetitive globally and just lead to higher prices here. Critics see it as trying to turn back the clock on technology and globalization based on an outdated model of industry.
Okay, lots of valid criticisms, but let's go back to the core strategy. Miran's plan seems based on this idea of leverage through disruption. Tariffs aren't just taxes, they're negotiating leverage.
Yes. And the sources hint that the pain Americans feel from higher prices or the instability in markets, maybe that's not an accident. Maybe it's part of the plan.
You mean the disruption is intentional? To pressure other countries?
That seems to be the implication. Create enough friction, enough discomfort, that trading partners feel forced to come to the table and agree to new terms like letting their currencies rise or investing more in the U.S.
Well, it reframes Trump's actions, maybe. From just being protectionist or chaotic to being a deliberate, if aggressive, bargaining tactic, using short-term pain for long-term strategic gain. The chaos is the method.
And this is where it gets really interesting and maybe seems like a contradiction. We know tariffs, in the short run, can actually make a currency stronger because they reduce demand for imports.
Right.
Yet, Miran's ultimate goal is a weaker dollar to boost manufacturing. How does that work?
Yeah, how do you use a tool that strengthens the dollar to weaken it?
The key, according to the sources, is how the tariffs are used as leverage. One passage notes specifically that after a series of punitive tariffs, trading partners like Europe and China become more receptive to some manner of currency accord in exchange for a reduction of tariffs.
Ah, so the tariffs aren't just about the direct cost of imports. They're the stick, the bargaining chip to force other countries to strengthen their currencies relative to the dollar.
Exactly. You create enough economic pain with tariffs that other countries say, okay, we'll agree to let our currency appreciate if you back off on the tariffs. The end result for U.S. trade competitiveness is similar to the dollar weakening, but it's achieved by pushing other currencies up.
That's a much more complex, indirect strategy than just slapping on tariffs and hoping for the best. It's about forcing currency realignment through trade pressure.
It is. But we still have to remember Miran also floats those more direct and highly controversial ideas for weakening the dollar itself, like messing with reserves or the 100-year bonds.
Right. Those are the ones critics call potentially dangerous.
Yeah, because they highlight just how incredibly difficult and risky it is for any country, even the U.S., to try and actively manipulate the value of the world's reserve currency. Trying to force it down could backfire spectacularly, cause financial chaos, destroy trust, invite retaliation. It's playing with fire.
A very high-stakes game indeed. Okay, so understanding all this, how does it help you, the listener, navigate this shifting world? If the goals are reshoring and supply chain security, where are the potential growth areas?
Well, based on the plan's logic, domestic manufacturing seems obvious, especially steel, aluminum, autos, the direct targets of tariffs. But also maybe semiconductors, pharma, critical minerals, if the reshoring push really takes hold.
And companies that already have solid U.S. supply chains or can adapt quickly to reshoring, they probably have an advantage, right? More resilient, less exposed to tariffs. And the defense industry seems linked too, given the whole economic security angle.
Definitely. On the other side, where's the risk? Which sectors might decline?
Industries that depend heavily on imported components or materials, they're facing higher costs. That either squeezes their profits or means higher prices for consumers.
Makes sense.
Export-focused businesses are also vulnerable, especially if they sell into countries that slap on retaliatory tariffs. We saw that hit agriculture hard before.
Yeah, farmers felt that pain.
And then just general consumer goods importers and retailers, they face higher costs on potentially thousands of products. That could mean inflation, slower sales, pressure on their bottom line.
And in the currency markets.
Expect volatility. Tariffs might boost the dollar short-term, but keep an eye on that longer-term goal of devaluation Miran talks about. Any real sign of a Mar-a-Lago Accord or big shifts in central bank reserves would be huge news.
And the sources mention that in uncertain times like these, traditional safe havens might do well, Japanese yen, Swiss franc. Gold also gets a mention as potentially benefiting if Miran's scenarios play out.
So for businesses, for investors trying to figure this out, what are the key takeaways? What should they be doing?
Top of the list has to be supply chain resilience and diversification. Really look hard at where your stuff comes from. Explore reshoring, nearshoring, at least reducing reliance on any single country. especially potential adversaries.
Makes sense. And currency hedging, if you operate internationally, seems like a must.
Absolutely. And maybe look for investment opportunities that align with this trend. U.S. manufacturing, infrastructure that supports domestic production, automation tech,
And critically, you have to watch government policy like a hawk, right?
constantly. Section 232 divisions, new tariff lists, any whispers about currency deals. These can move markets instantly. You need to stay informed.
Because the sources suggest this isn't just a cycle. It could be a real fundamental shift in how global trade works. You need a long-term view.
Yeah, thinking strategically about a world that might be breaking into trade blocks with more protectionism baked in.
And this idea of an onshoring premium is interesting.
Right. The idea that companies successfully bringing production back, or who are already mostly domestic, might get valued higher by investors. Not just for profits, but for that resilience, that alignment with national security goals. It adds a new factor to how you might value a company.
And because Miran's framework explicitly connects trade and security, kind of dividing countries into friends and foes.
Investment decisions might need a geopolitical lens now, alongside the financial one. Does this investment align with U.S. strategic interests? Is this company too exposed to an adversarial country? Finding that geopolitical alpha, as some call it, might become more important. It means understanding world affairs, not just spreadsheets.
Okay, so let's try and wrap this up. What does it all mean? Our dive into these sources shows that these tariff policies, which can seem erratic, they appear to be part of a deliberate strategy, heavily influenced by Stephen Miran's thinking.
Yeah, a strategy rooted in a critique of the whole post-World War II economic system. Arguing it created imbalances like the overvalued dollar and led to U.S. manufacturing decline, problems really laid bare by the pandemic.
And the argument goes, because the WTO seems broken or too slow, unilateral action like tariffs is needed. Not just for protection, but as leverage to force currency changes and rebalance the whole system.
But this vision faces serious, legitimate criticism about whether it can actually work. Who pays the price? Consumers. And if it can really bring back those old manufacturing jobs in today's automated world.
The future really hangs in the balance. It depends on how the strategy plays out and how other countries respond. Success, for the proponents, looks like revitalized U.S. industry, a rebalanced global order. Failure could mean trade wars, inflation, a fractured world economy.
But for you listening, whether you run a business, invest, or just want to understand these huge changes, adapting is crucial. Resilient supply chains, smart currency planning, maybe looking at domestic investment, definitely keeping tabs on policy.
And recognizing this deep link now between economics and geopolitics, thinking about that onshoring premium, that geopolitical alpha, it's essential for navigating what comes next.
This really is a defining moment for the global economy.
It absolutely is. And it leaves us with a big question, doesn't it? If this strategic disruption is, as the sources suggest, intentional, can we get back to some kind of global economic stability without the U.S. backing down from these core goals? Or are we just entering a new normal where trade and geopolitical tension are forever intertwined?
Something to definitely chew on as you navigate this new world order.